It's September 1998, inside a conference room at the Federal Reserve Bank of New York. The heads of the biggest banks on Wall Street have been called in for an emergency meeting. Not because of a terrorist attack. Not because of a stock market crash anyone outside finance had even noticed yet. Because of one hedge fund. A fund run by some of the smartest people to ever work in finance, including 2 Nobel Prize winners, was about to collapse, and regulators were terrified it might take the entire global financial system down with it. This is the story of long-term capital management, the fund that was supposed to be mathematically incapable of failing. Long-term capital management was founded in 1994 by John Meriwether, a legendary bond trader who had built his reputation at Salomon Brothers, one of Wall Street's most aggressive trading houses. Meriwether wasn't just well respected. He was considered one of the sharpest minds in fixed income trading anywhere in the world. When he set out to build his own fund, he didn't just hire good traders. He assembled what many in the industry still call the most intellectually stacked team ever put together on Wall Street. Among the founding partners were Myron Scholes and Robert Merton, 2 economists who would go on to win the Nobel Prize in economics for their work on options pricing, the same mathematical models that much of modern finance is still built on today. Also on the team was David Mullins, a former vice chairman of the Federal Reserve itself. This wasn't a scrappy startup fund. This was, on paper, the closest thing Wall Street had ever seen to a sure thing. Investors lined up to hand over their money, and long-term capital management opened with roughly $1.3 billion in capital, an enormous sum for a hedge fund at the time. The strategy was built on something called relative value arbitrage, complex trades designed to profit from tiny, almost invisible price differences between related securities, differences so small that ordinary investors would never even notice them. The math behind these trades was elegant. The historical data behind them was reassuring. And for years it worked spectacularly well. In its first year, long-term capital management returned better than 20% to its investors after fees. The next year it did even better. By 1996, the fund was posting returns north of 40%, numbers that seemed almost impossible in a business where most managers would be thrilled with half that. Wall Street banks competed with each other for the privilege of lending money to LTCM, offering it extraordinarily generous terms because everyone wanted a piece of the fund's success, even indirectly. The partners at LTCM weren't just seen as smart. They were treated, inside the industry, almost like celebrities of quantitative finance. Their models were treated as gospel. Their trades were copied by other funds who assumed that whatever LTCM was doing must be correct. And here's the detail that made the whole operation so seductive, and so dangerous. LTCM wasn't just making bets with its own money. It was borrowing enormous sums to amplify its returns, a strategy called leverage. At its peak, the fund controlled roughly $125 billion in assets while holding only about $4 to $5 billion of its own capital. That's leverage of roughly 25 to 1. And when you count the fund's derivative positions, the total notional exposure ran past $1 trillion. As long as the models were right, even slightly, that leverage turned small, safe-looking profits into massive returns. Nobody at the time seemed especially worried, because the fund's own risk models suggested a catastrophic loss was almost statistically impossible, the kind of event that, according to their own calculations, should only happen once in many lifetimes of trading. Then, in the summer of 1998, something happened that LTCM's models had never adequately accounted for. Russia, buried under debt it could no longer service, defaulted on its government bonds and devalued its currency. To most of the world, this looked like a regional financial crisis in a single struggling economy. To global markets, it triggered something far larger, a sudden, panicked flight toward safety. Investors everywhere began dumping anything considered risky and rushing into the safest assets they could find, mainly U.S. Treasury bonds. LTCM's entire strategy depended on the relationships between related securities behaving in predictable, historically consistent ways. Prices that were supposed to converge over time were instead diverging violently, in ways the fund's models treated as almost statistically impossible. Positions that were designed to be nearly risk-free began losing money simultaneously, across nearly every market the fund was involved in all at once. This was the nightmare scenario buried deep inside LTCM's own risk calculations, the outcomes so unlikely their models barely accounted for it at all. And because the fund was so heavily leveraged, even a relatively modest move against its positions turned into catastrophic, accelerating losses within days. Through August and into September of 1998, the losses at long-term capital management became severe, then alarming, then genuinely frightening to anyone watching from inside the banking system. In a single month, the fund lost roughly $1.9 billion. Then more. Every attempt to unwind its enormous, complex positions only made things worse, because the fund's trades were so large that trying to exit them moved the market further against itself. Other traders, sensing LTCM's distress, began trading directly against the fund's known positions, making a bad situation catastrophically worse. By September, the fund's capital, which had stood near $5 billion, had collapsed to under $500 million, while its exposure to the market remained almost entirely unchanged. The math was brutal and simple. A fund controlling over $100 billion in positions was now operating with almost nothing left to absorb further losses. Wall Street banks that had lent LTCM enormous sums suddenly realized their own exposure. If LTCM collapsed entirely and was forced to liquidate its positions all at once, the resulting chaos could ripple through every major bank that had lent to it, and potentially through the broader financial system itself. This is what brought regulators into the picture. The Federal Reserve Bank of New York, worried that an uncontrolled LTCM collapse could trigger a genuine systemic crisis, summoned the heads of the major Wall Street banks into a room and pushed them to organize a private rescue. Not a government bailout using taxpayer money, but a coordinated bailout funded entirely by the banks themselves, banks that had every incentive to prevent LTCM's implosion from taking them down too. In late September 1998, a consortium of roughly 14 banks agreed to inject $3.6 billion into the fund in exchange for the vast majority of its ownership. The original partners, including Meriwether, Shoals, and Merton, were left holding a small fraction of a fund that had once made them appear untouchable. Long-term capital management was slowly wound down over the following months and formally dissolved in early 2000. What makes this story endure more than 2 decades later isn't just the size of the losses. It's what the collapse revealed about a certain kind of arrogance that can creep into even the most brilliant minds in finance. Nobel Prize-winning economists, a former Federal Reserve vice chairman, legendary traders, all of them had built a fund on the belief that their models could account for nearly any scenario the market might produce. What they hadn't fully priced in was human panic, and the way genuinely rare events can arrive all at once, correlated in ways historical data simply hadn't captured. Economists later gave this phenomenon a name inside the industry: the illusion of precision. The dangerous comfort of believing a sophisticated model has truly captured the full range of what markets can do. The Federal Reserve's involvement in organizing the rescue, even without direct taxpayer money, sparked a debate that still continues today, about whether institutions considered too interconnected to fail quietly receive protection that ordinary investors never do. Regulators pointed to LTCM for years afterward as a case study in the dangers of excessive leverage and the limits of quantitative risk modeling, lessons that, a decade later, much of Wall Street would need to relearn all over again during the much larger financial crisis of 2008. Some of the smartest people in finance built a fund almost nobody thought could fail. It took one summer and a chain of events their own models called nearly impossible to bring it to the edge of collapse. Long-term capital management remains one of Wall Street's clearest warnings that brilliance and certainty are not the same thing. If this story fascinated you, there are more forgotten Wall Street collapses waiting on this channel. Subscribe now so you don't miss the next one.